we have a fantastic panel. We had a wonderful prep session, which I'm sure will end up having been better than the actual session we're going to do now. But maybe you can just, like, one word introduce yourselves, maybe starting with Peter and going down.
Good afternoon, everybody. Peter Lenhardt, IREMIS, Head of Hotels.
Hi, I'm Lisa. I'm with Vertic Capital.
I'm Andrea. I'm an investment director at Pygmalion Capital.
James McNamara at Schroders Capital.
So basically 4 investor groups on the platform, which is what you should have at an investor session. So guys, we wanted to talk at first about hotels as an asset class. And obviously you've had 2 very difficult years for fundraising generally. I think the fact that hotels have got a bigger and bigger slice and living, beds, accommodation, whatever you want to call it, has had a bigger and bigger slice of real estate investment, maybe disguises the fact that real estate investment itself has been in trouble. And real estate allocations have been shrinking. So how do you see it? Do hotels as an asset class now outrank offices? Do they outrank retail? Will they keep that, or is that going to fade back again? And will they become, we talked about this on the call, will hotels become mainstream as living becomes mainstream? We were hearing today, beds is a real sector. We were discussing this on the call. I don't think you all agreed with that. But is the combined beds, accommodation, living world a new mainstream sector, or are hotels going to stay alternative? Who wants to? James, I know you had some strong views on this.
I don't really think of it in that way. I mean, for me, we divide things into infrastructure, private equity, and real estate, and those lines have blurred so much. The skills are overlapping more and more, so we don't really even divide those as much as we used to. Within real estate, people do focus for tax reasons and other reasons on the operational aspects versus the pure real estate. But I think everyone on this panel, increasingly want to have more control of the asset, so you want to control the operations and the property. So we don't see it as a niche asset class. I think all of operational real estate is going much more similar to hotels. The sort of passive view that you could own an office and collect rent, that's long gone. So, hotels was out on its own, but increasingly everything is looking like a hotel now. So.
Yeah, I think we agree with that. But I think in the wider context of real estate, I know hotels have grown, and actually year on year they've done very well in comparison. So they've managed to increase their share out of the total of commercial real estate transacted in Europe. But we're still just under 10%. Out of the entire total of about 200 billion of commercial real estate that was transacted in Europe in 2024. So there's still quite a way to go. Living, offices, and retail are still the preferred asset class, but I do agree with you that a lot of those asset classes are becoming more similar to hotels, so you can have a lot of synergies there.
I mean, you say they're preferred. I mean, who the hell has preferred their returns on retail or office since COVID? It's been awful, right? Generally speaking. Okay, prime is fine, but...
Well, hotel returns during COVID weren't shining either.
That's true, that's true. But the bounce back has been better.
Yeah, and I have to admit I'm in 2 minds about hotels becoming mainstream or not. Of course, it's from a capital raising perspective, it's great. I know nothing else than hotel investments. So from that perspective, if there's a bigger pie, better for me as well. At the same time, it's kind of nice to stay specialist. Niche sounds almost a bit limiting, but being a sector specialist has an appeal to it too. And I guess for many of us, the role we fulfill in the sector is very much that of translating hotel operations into real estate returns. So from that perspective, I think a mix of both would be nice.
And I completely agree with that. I would add 2 elements to it. If you look at hotels from a yield perspective compared to student housing and resi, hotels are still significantly priced at a higher yield because of the complexity. So I completely agree that this is a specialist asset class to date. In terms of capital raising, that's a tricky topic. And if I speak about our investor base, which is mainly German institutionals, they have an issue that they are very willing to move into hotels, but before they can reallocate to hotels, they need to sell some of the other stuff. And that is not that easy in the current market.
Right.
And there is a rebalancing of portfolios that we are probably going to start seeing. There's been asset classes that have been in favor. We're talking here about logistics, data centers. In the living sector, you probably had quite a lot built to rent, single and multifamily sector that has been quite favored, let's say. But now a lot of the investors have had a lot of exposure to those asset classes, and they do need to rebalance their portfolio. One element is also probably people looked a lot more towards the debt side, so now they need to come back to the equity side, as you probably need to look at returns as well. You probably won't be able to find those in debt anymore, that were competing actually with equity returns.
Yeah, I mean, that's certainly true. James?
Yeah, I think the industry is just maturing, where you don't just allocate to industrial, you're allocating to cold storage, self-storage, last mile, and increasingly this area of specialization is happening across what we used to call generalist real estate investing. So yes, there's a bit of a portfolio top-down allocation, but people are very much focused on themes and how to express those themes in different types of real estate.
So do you think your LPs, I mean, you're all out there raising money from primarily institutional capital. There was a time when the lease was in favor because it was safe. Did COVID bust that? I mean, all the big operators retraded their leases. It wasn't even a question of covenant. It was just, well, I can, so I will. Did that put people off? I mean, are they willing to take the operational risk to look at the HMA, to look at the franchise much more?
It does work very well as long as it's correctly cut. So what happened was, because you're taking a pound from the OpCo and putting it in the PropCo at a much higher multiple, people were incentivized to grossly inflate their rents. And you didn't have that proper partnership between the landlord and the tenant. If you set these leases correctly, return irrelevant, it does make sense to share the risk. But you have to manage that with the team who are able to step in and take over the tenant if they need to. And that creates an honest partnership between the tenant. The trouble with the business model was that it became a very low-fee, passive rent collection business. So people would collect a large portfolio of leased assets managed by 2 or 3 people, and when there was a problem, they weren't able to deal with it. They weren't able to support the tenants. So there wasn't that real partnership approach. But if you're operating hotels day to day and you have a few leased assets on the side, that makes a lot of sense.
It's a balance. Your portfolio, you'd always want a little bit of balance, would you?
Yeah.
I mean,
Yeah, and not every lease is
like that.
a lease as people typically think of it. There is that fixed lease model, which we have always been saying is in the end an illusion of security. Because if you look at the tenant's portfolio, if all of them go into turmoil, they can never sustain those payments. However, if you structure it correctly, as you suggested, and perhaps you even have a turnover component or a profit-sharing component on top of the fixed lease, that becomes much more of a manageable specialist asset class that you can actually drive value in and work with the tenant to both make money.
And I mean, as part of that, we've seen this trend towards portfolios, right? That buying platforms or buying portfolios is generally now favored. And is that partly because you're buying the operator, you're buying the manager, you're buying the expertise? Is that part of it? I mean, you're selling a portfolio at the moment, right, Andrea?
Yes. So I think, well, there's several components. I think platforms and portfolios, one is the platform, and then you can have a real estate portfolio. I think what we are seeing is that definitely there's much more interest in portfolios, particularly because the capital tends to want to deploy higher amounts in 1 or 2 transactions. If you go granular below 50 million, it's very difficult to have the right team in place to do all of the granular work that you need in order to aggregate for a portfolio. Right now, we are on the market with a portfolio, so I can't say a lot of things about that. But one thing that I can say is that we've had substantial interest, which was quite amazing to see, which one spoke to the destination. We are selling a portfolio in Spain, so it's really a testament to how well the market has done and to how well the asset management team has done. And this portfolio is actually has a variable lease in place, and probably the asset management team has worked the most on this portfolio. So just because you have leases, in order to generate value and to really drive the returns, you would have to really focus on having a great relationship with your tenant. But yeah, we're seeing a lot of traction with this portfolio, so we're very pleased.
Well, who's looking? Without naming names, what sort of buyers are looking? Is it mostly PE, families, Spanish operators? I mean, who's?
So it's really a mix of all of those actually, and it was quite great to see that it was a portfolio that sort of proved the concept that we wanted and how we started, how we are looking at hotel investment, which is sort of de-risking acquisition, implementing a business plan during the holding period, and then keeping a lot of flexibility in order to guarantee liquidity at exit. And that means that having that, which we always want to have that flexibility at exit, means that we can attract a wide pool of investors and really let the market speak in a competitive process.
And you think that the flexibility is a key factor?
For us, yes. I think it's one of the ways that you can hedge a bit your business plan. I mean, we have to say that we've managed these assets and through COVID with leases, and it only came from a very good relationship with the tenant. And we were able to operate these assets, see them through COVID, and still have and exceed expectations of returns. So, by having a great entry, good business plan in the middle, and great relationship with the operator, and then a highly visible and flexible exit.
Okay, and you've just started your new ventures, really. You're making your acquisitions. What are you looking for?
We take it the other way around. We like to buy small assets, build them in portfolios, and then sell them off to bigger groups. I mean, we have done that at Internos Principal with AXA, and we have sold more than 500 million to them, which we have acquired in granular pieces over a period of 7 years. So I think there's a lot of value to create if you are willing to put in that work.
Do you get a strategic premium because you've got a portfolio, or is it just easier to do and you've done the hard work? Because when we were selling Hospitality Europe, and I'm going back a long time, we hoped that there was a buyer who'd go, hey, look, there's a portfolio of 8 great institutional quality assets. I can buy them all at once. I'll pay up for that. I don't think anybody actually paid up for it. They valued it fine. It was one deal, but I don't think we got a premium over the individual prices. But do you think you did? You think you might have?
I think we did fairly well, but that was a different market in 2019. I mean, everybody was falling over themselves to buy hotels. I don't know whether that market is still out there. I think that today we are much more in a market where, as you've alluded to, people are looking for value-add opportunities where they believe they can create future value, and some of them are willing to pay for that future value already, which I think is quite dangerous.
Okay.
I think that idea of buying single assets and sell a portfolio was just an earlier stage in the market. The market's now at the stage in almost all real estate asset classes where investors are buying in and out of companies. So you would, Logicor is a great example. Blackstone assembled a portfolio, put a management team around it, sold the company itself. They would have thought about IPOing it, and they've done it multiple times in multiple different segments where you just create a management team around a cluster of assets and investors come in and out of it. You don't need to be listed to do that anymore. Private markets are much more efficient than they were. There's capital raisings. So the market's just evolved. Private markets have evolved. And there's a lot of friction costs, and it's timely to buy and sell assets. So let's create the companies and buy and sell the companies.
And you got a bit of both, right? You got single assets and you bought a company.
That's it. So basically, Vertic, we consider ourselves a hospitality investor in the broader sense. So we invest in hospitality real estate, but also in operating companies. And actually having our own operating company in-house gives us a lot of the flexibility on exit that you mentioned, for example. So we can acquire individual assets or portfolios. We don't, and then use the scale of the operating company that we have at our disposal to really drive value without encumbering the asset long term. And I think that is quite a unique position that we created for ourselves in this space.
Okay. And when you're talking, I mean, you're all probably going out talking to investors all the time. So a couple of things. Are you finding that they are being lured into all the other types of operating real estate and away from hotels? Or is it that they're getting comfortable with service apartments, PBSA, maybe branded resi now, and then they're going, actually, you know what? Maybe hotels isn't such a stretch after all. So is it being helpful, this gradual merge to raising funds for hotel acquisitions, or is it to some extent maybe leaching money away into other things?
I don't see the blend so much. I think it's still very, very separate strategies with investors. What I think has happened over the last 10 years or longer is also LPs have gotten more sophisticated. The market has been maturing, as you said. So when you go through a due diligence process, the questions you get back are a lot more sophisticated than they used to be. So in a way, it's a great training ground for us as specialist investors as well to, up our game as well.
And a lot of the LPs are moving into, in those easier to operate living sectors into their own operations, which obviously gives them quite some knowledge into it and allows them to ask those questions.
Yeah, we're finding LPs are very sophisticated. They have all the data you're going to have. They're underwriting themselves. They're visiting the assets. They have views and brands, whether there could be any brand value at the exit. And a lot of them will, in the high net worth channels, personally own hotels. So they come with a lot of opinions and views, which is fantastic. So it's very different to how it was.
Yeah.
I think one area where we see that we can 100% add value is really on the sourcing. So we do a lot of distress acquisitions, and there you really need to have, number one, a lot of patience to follow the deals. And number two, you need to have a lot, especially in Europe, a lot of knowledge about the bankruptcy, insolvency frameworks, and so on, which I find that sometimes LPs don't necessarily look at or want to spend with. So for us, it's a key focus in trying to really buy well and out of situations that are truly off market or unlocking situations that would not necessarily appeal to a traditional investor, let's say.
Yeah, you're at the high risk, high reward end, I guess. I mean,
Yes.
There's not many players really there, are there? I mean, there's people like Cerberus, who really go for the distress. But I mean, the other three, Peter, do you go for real turnarounds, really distressed situations, Schroders, Vertic? Do you guys look at that? Or is it more sort of value add and core plus?
So for us, it's not so much the distressed side of things. We wouldn't shy away from that when we see an interesting opportunity, but that's not where our focus has been. Our focus really has been on value add opportunities where we can deploy our knowledge of the operation, of the benefits of branding, of the operating structure to be brought to the table, and sensible and targeted CapEx spend to really drive operations. So that's what we've been focusing on. Now, per your point, James, and you mentioned as well, data availability is huge right now compared to where we were, a decade back. So the LPs can definitely rival you on that. I think where us as specialist investors can add a lot of value is to differentiate what of that data that is out there can actually really drive value, because there's a flood of data. How do you differentiate what is the most relevant to focus on? And that is something where we bring the operational expertise to the table.
All right.
I mean, we spend a lot of time with our assets as well. The asset we just bought in Dresden was operated under a management agreement and a franchise. We terminated both and put a lease in place. We're now refurbishing the asset top to bottom. So that is for us already quite some value add. It depends, obviously, always on the going in price, whether you buy it distressed or whether you buy quickly or whether you find something that is not on the market. This is really where you drive the value for investors in the end.
Quite unusual to hear of somebody taking out a franchise in the HMA and putting in a lease. That's kind of the opposite to where most people are going. Why do you have a lease? Because your investors really want a lease, or because you like the security of the minimum guarantees?
No, it's regulatory restraint.
Okay.
I mean,
So
our
your investors
are
are German.
pension funds and insurance companies. They can't do anything
So
else
you have to
than
have
a
a
lease.
lease. Yeah. Okay.
And our leases with a minimum guaranteed and a variable on top, I think they're actually quite a good model to get value out of an asset.
Yeah. No question.
Interesting when you hear the property could be worth more than the holdco, the propco more than the holdco. It's counterintuitive. You think giving away the opco should have some value, but interesting.
Yeah. Well, it depends where your investor pools are and how they're pricing, right?
Your rent sustainable.
Yeah, that's the whole problem with the split. I mean, Hostel exists as our owners' organization because of the split, but the amount of friction it creates is quite substantial.
But it's a very interesting debate, how big the spread between a management agreement and the lease is these days, and particularly for a variable lease income, how much is there an uptake compared to a management agreement? That, particularly on the continent, I think is a very interesting debate to have and to be seen. I think it's screwed at the moment by the fact that most of the big German institutions are out of the market and not buying because they were the ones paying top dollar for leases in the past. So let's see how this evolves over the next 5 years.
True. Yeah, you're right.
Just going back to your point on distress, you need the full toolkit. I mean, most of my career has been in distress, but there hasn't been a lot of distress over the last few years. even during COVID, there was a great play in hotel CMBS in the US, but there was very little to do in Europe. There was a lot of subsidies and balance out, so you didn't see a lot of distressed debt trades. We're now at the stage in the hotel industry with a great trading performance, so we haven't seen seller pressure coming out, so you've seen buy-seller gap and low volumes. So we pivot, all of us, to operational growth, and of course now, next year, much more cost management, managing the volatility. But investors need a full toolkit depending on where you are at any point in time, what the opportunity is.
I mean, we didn't really discuss this, but obviously you've had a lot, as you've all mentioned, a lot of debt investment going in the last 2 years. And some of that is going to come due, and the assumption was it'll be easy to refinance because interest rates will fall, banks' balance sheets will be rebuilt, credit committees will come under pressure, blah, blah, blah. Senior lenders will be back, and clearly to some extent they are. But do you think some of the newer credit funds might get stuck, that actually the refi isn't as easy, the equity isn't there, and you might even get the debt funds being semi-distressed sellers? Is that, or am I over-egging that? Do you think there's going to be any accidents in this? You've obviously had a few juicy debt deals in the last few years.
Well, from an investment liquidity perspective, we hope there's going to be more movement to the market. I mean, over the past few years, it's been held back by very strong trading performance, kind of like brushing over the underlying structural concerns about higher interest costs and so on.
Yeah.
And we've seen more investment pipeline coming to the market now, but still not enough to really see what we would consider a fair adjustment of pricing. So I hope that will get corrected as more investment supply comes to the market. Right now, supply is clearly not as big as the investment demand.
But on the capital stack question of like how are refinancings or financings happening these days, I mean, to your point of maybe not seeing distress, we've actually found quite a bit of, particularly in the capital stack, and maybe some of those are coming from situations where the lender didn't really have the best idea of like sort of how a hotel operation is supposed to happen. So we are seeing those specific situations. I might agree with you, it's not portfolios, but individual cases. And in those situations, we look at coming in as a solution of trying to unlock that, because both the borrower and the lender are stuck, they're frustrated, and a solution needs to be found. And that's where we try to focus our attention of really trying to unlock consensual deals in that space.
Okay. Should we open it up to the audience? Does anyone in the audience have any questions? They're a pretty stellar panel, so I hope somebody might have something to ask. Somebody at the back, did you say?
Who's waving at me?
No.
Nothing at all.
Okay, well, unless Andrew has one, because he usually does.
Well, yeah, go on. I'll ask one.
You would in the end.
Talking about the credit funds piece, I think, which is fascinating at the moment. So what I'm hearing from people is that the yields on those are coming in quite a bit. So 15% is now 12%, et cetera, et cetera. I mean, it seems to me that this can only be a temporary business model. It exists because the senior lenders haven't been present and they've needed to come in and do a sort of cure to the capital stack. But then I talk to the credit funds and they tell me, oh no, we've got a long-term business model here with this. There's a need for us to exist. I'm interested in what your thoughts are. Are they a temporary thing or are they a long-term thing?
I think it's a long-term thing. I think what you're seeing at the moment is that there was a period, certainly over the course of last year, the risk return for someone putting out a whole loan up to 65, 70% of whatever they thought the V was, putting in place a refinancing behind that and holding the implied mezz. It was a super attractive returns. A lot of our LPs were getting 15, 17% returns on that. Not typically long duration. You need to get a 2-year make-whole. So clearly a refi risk as the market returned. And those that didn't return were really, questioning the V. I can think a longer term question is what happens after those 2 years. You've seen a lot of new entrants to the market, a lot of competition if you're going for debt at the moment. So you will get 6 bids on that kind of basis. That will push values down, push pricing down. But it does feel bigger, stepping back, big picture, shift from the banking market, as banks are pulling back into the private debt market, that feels like a huge structural trend that we're at the very early stages of doing. So to your point is, it's a short-term investment opportunity, but a huge trend in the market of the scale of it.
Anybody else seeing anything different? Presumably not. Okay. We talked a lot this morning about inflation and staff costs. Does that factor much into your analysis? And if so, do you know what to do with it? I mean, do you know how to forecast anymore with the world in turmoil? Or is it, you just, okay, we know we've got a minimum wage increase in the UK and we know we've got the wage cost pressure. I mean, Andrew's point, which I first heard from an economist at the Ismaili Owners Club, none of whom will obviously be here today, about the shift from capital to labor, where it was more extreme, that chart. It was 60 to 40, I think. And there's obviously a global pushback by global labor, which inevitably is happening. And as Uffi basically pointed out, the government wants it to happen. They want higher wage, higher skill, greater efficiency in the hotel industry labor force. Is that coming through? And is it still affecting your underwriting, or are you assuming that AI will effectively even it out? Or is it not really a big issue for any of you when you do an underwriting?
So in terms of looking at the labor costs, I think this has been a topic for a while. I think that the problem with labor costs presently on a short-term basis, it's mainly the fact that business plans have been pretty much optimized after COVID. We've pretty much stripped out everything we could. We've invested in all of the MEP to increase the energy efficiency. So you're pretty much now trading at an optimized level, or you should, if you've done what you were supposed to do in the last 5 years. However, the problem is mainly on the top line. If we see any inflection in demand, I think it'll be quite difficult to sustain the same margins. And that's where the issue with having a potential reduction in top line and an increase in costs, that's where we see the difficulty. It's not just labor costs per se, it's just not having any flex in the P&L to make it deliver the same amount as you had in the past.
I'd second that. Labor costs for us have been a challenge, but at the same time, top line performance has been able to offset that to some degree. It's becoming more of a concern now that there are first signs of top-line growth slowing down.
Yeah, I mean, the States is usually a leader, and it's flat, and GOPs are down, I think it's all 5%.
Yeah, but then again,
mass,
the president is a hotel owner, so we have something to hope for.
And you should look at different markets in Europe. When we talk about
that was the last question. What markets do you?
No, but if you talk about this, we should talk about different markets, because obviously Spain and Italy and France to some extent have been seeing phenomenal great growth since COVID, but other markets haven't.
Payroll of top line.
Of top line. Payroll, I think, is growing more steadily across the countries, in my view, at least. And the problem is that for some countries where top line wasn't growing that fast, the GDP decrease is already creeping up quite significantly. And I think these are the markets we should be more carefully looking at in these areas.
It goes back to the start. You have operational assets. You want to control their operations, and you want to be able to adapt to whatever the market's throwing at you. We have a lot of concerns about F&B revenues, a lot of cost inflation there as well. You spend a lot of time on food procurement, a lot of the staffing models, but you can't fight the wave of this rising salary per unit cost. So that's continued to come. You assume it's going to continue to come. It's likely you're going to be taxed everywhere because you can't run, so you're going to be taxed on every bit, guest taxes, everything. So that's likely to come. So you just have to be constantly adapting your business model to get your fair share of that market and keep adapting. And that's certainly what you're going to be in your underwriting. Be very concerned about, underwriting your permanent profits from any of these segments. I mean, betting on F&B is not a comfortable spot right now.
So then looking at the next year, we're nearly out of time. Which country, which type of hotels, what structure, what do you look at?
Well, being fed by German institutions, we obviously focus on the DACH region, also because interest internationally is not as big there at the moment. And if you look at transaction volumes overall in 2024, Germany had a crap year in terms of hotel transactions. And I think that's where the opportunity lies.
We, like pan-European as a whole, so I'm struggling to focus on any particular country. I see a lot of interesting dynamics in Southern European countries. We very much like the efficiency of the UK market, and you'll find us in the space with more operational complexity.
Upscale, mid-scale, economy, whatever that word is now, it
How about
changes every time.
lifestyle?
Oh no, please, no, not that. But you like upscale, mid-scale, economy, lifestyle, boutique, wellness hotels?
Probably
Yeah,
not so
okay.
much. I wouldn't rule out economy, but for now our focus has been very much as the assets we currently own already represent. So lifestyle,
So I
upscale.
forgot, economy is now focused service.
Oh,
Through my life, it was budget, then it was economy, then it was limited service, then it was select service, and now it's focused service.
Yeah.
Fantastic. Those marketing guys, they earn a lot of money. Andrea, what about you? Where are you? I mean, you're selling, but you're also raising a fund and buying, or you're looking to buy, right?
Yes, absolutely. I think where we see the most opportunities, at least for what we do and what we specialize in, is Italy, quite strong. I think the performance there has been very good, and speaking to a previous panel, there are a lot of succession problems. There's still a lot of capital stack issues that need to be solved, so we see a lot of opportunities coming from Italy, and then France as well. And probably in terms of segment, mid-scale and above.
Any market with high barriers to new supply, given where values are, so your Barcelona, Amsterdam, Venice, etc. Assets which are large enough to where you can really work them hard, so over 100 million, so key gateway cities of proven demand, and assets where you've got multiple value drivers, so that would typically be in upper lifestyle, whatever you want to call it, but you're not betting much in F&B, but you're going to be large ground floor areas where you can adapt and do other things with them.
Fantastic. Andrew, you managed to put together my panel, all of whom have slightly different angles, which is, I think, fantastic, and that's how the market goes. We're out of time on here. Do you have time for questions? Does anyone have a question? If not?
Oh, we have one up there.
Gina, here we go.
You mentioned underwriting earlier. What level of RevPAR growth are you underwriting in 2025 when you're thinking about Europe as a whole? And then two more questions, they'll probably be quick. When your franchisees, which brands have the highest exit value today?
Oh.
And then is key money a larger driver in your brand decisions today?
Oh, boy. Let's start with James at the other end. So.
RevPAR no more than 2%. I mean, we're a buy, fix, sell model, so you're looking to get the thing up to where market is, but you're not going to pay for market growth. If you get it, and you hope to do, that's great, but it will not be in your underwriting. And then the second question was on key money, was it? Key money,
No,
that's just a
which
debt.
brand gives you the best exit value?
Oh gosh, there's been a real pushback on management contracts. It's quite hard to get liquidity on a management contract. I think again that evolution of the model. In terms of franchise, it's just constantly evolving. So we don't really put any value on these. We think these brands, whatever is the hottest, latest, greatest thing now, when you're selling it 5 years, it'll be out of fashion. So I don't see any value in that. But it's a really important part of our business model. But it just will constantly change. So I wouldn't ascribe value to it.
I thought you'd say Hilton.
I think from our perspective, it's hard to give you a straight answer on the RevPAR growth we underwrite. I think overall, if you can keep it inflationary on a market level, that's probably a good target for the next few years to come. But then again, our investment interest is not buying an asset and then just riding the market, but indeed, doing stuff to it in order to boost its performance over and beyond where it's been. So therefore, we, of course, on those occasions, underwrite growth above inflation on these assets. And in terms of brands, also that, I think, depends very much on the market, current representation in the market, strength of distribution system, your customer composition, and so on. What is important in those discussions for us is less the key money, but more flexibility on exit.
So rather the Taube auf dem Dach als lieber den Spatz in der Hand.
Yeah.
Yeah, I think in terms of like franchises, you really cannot put a blanket. I think you need to look at the market where your hotel is and where it's franchised, and really look at what the franchise is delivering and what market segment are they bringing in. It's very hard to say that one brand will work everywhere, and that's really our job when we buy assets and do value add, is to pick the right brand that will ensure that you have the liquidity through negotiation, and probably maybe the question of key money should always be there, but the shape that the form that the key money value takes is probably better if it's up for negotiation.
I mean, you're selling your portfolio Silken, and you've been quite happy with that as a partner, right? My impression.
It works very well in the markets where they are and with the segments that they are driving.
Stop there. I just want to ask, how many people here have heard or had heard before the last 5 minutes of Silken hotels? Actually, quite a few, probably 2/3. So it's not bad, actually, right, for a relative, basically domestic brand. So you don't have to have what I'm saying is you don't necessarily have to have one of the big six to perform, depending on your market.
Yeah, it depends what your segments are and what you're working with. The hotels are performing super well with the domestic market, and because of their location and quality of real estate, they can attract international tourism, international demand as well. So it's not only about having the international label. In certain markets, you're probably better off having your own brand or a domestic brand or no brand at all.
Okay. Peter, anything to add before we finish? We're out of time.
I think that you need to look which brand or operator has the largest strategic interest in your asset, and that maximizes your value. And you would be surprised how different the offers may be.